I'm Evan Lazarus, Chief Knowledge Officer for T3Live.com. You don't become a great trader by watching videos and taking courses. You become a great trader through live screen time. Accelerate that learning curve by tapping into the experience of seasoned professionals. Currently, we're offering 5-day free trials to each of our 4 mentoring rooms. In the mentoring rooms, we teach our strategies in the context of the live market. To sign up for a free trial, go to the T3 Live education page, fill out the form, and get started when the next trading session begins. We hope to see you in one of our mentoring rooms.
Good morning, everyone. I'm T3 Live Editor-in-Chief John Darsie.
And I'm Brittany Umar, and together we bring you Morning Call. So futures this morning are basically unchanged after there was no real consensus that came out of Jackson Hole this weekend. John, first tell us, what are your thoughts on what came out of Wyoming?
Yeah, I mean, in general, people are expecting this to be a quiet week, and they were looking towards that Jackson Hole summit this weekend to see if there would be, any headlines that could stoke some volatility. But as we've seen over the last few weeks, and in general with monetary policy, you have really mixed opinions and no consensus on, will the Fed taper in September? Should they taper in September? Or should the easy money remain until the world economic recovery really finds its footing? You had some really strong opinions. One was from Christine Lagarde. She's the head of the IMF. She was saying that she thinks easy money should remain indefinitely until these world recoveries get a little bit more traction, especially in Europe and Japan. So you saw the dollar actually slip a little bit, which is providing some relief to equities now.
Right, and you mentioned it's probably going to be a quiet week. We have the Labor Day weekend coming up. So how do you think traders should approach this week? Yeah,
I mean, this is generally a week that a lot of traders choose to sit out, and that's evidenced by the fact that some of the bigger names with T3 Live aren't here this week. We have Mark Sperling and Scott Redler both sitting today out, and Mark will be out all week, and you'll see a common refrain like that among traders because when you get a light, whippy, low-volume tape, it can lead to moves that aren't exactly in keeping with traditional technical analysis. So rather than spin your tires and get frustrated, a lot of traders choose to just sit this one out, enjoy the nice weather as we end summer and stuff like that. So don't press or anything like that. Sit on your hands if you don't see a lot of things clearly, and there's nothing wrong with that.
Well, for those traders not sitting things out, what are the levels to watch?
All right, in the S&P, I think you take things short term right now as that's sort of been the theme heading into that September QE Fed rate decision. So you talk about Friday's high as a short-term level to watch, as futures are about flat this morning. And then you have the beginning of this gap in the spiders here. That's around 167.43. So that'll be the level, if we do continue to the upside, that people will be watching. You talk about to the downside, you have Friday's low, and then you have obviously this pivot down here from this recent move. The jury's still out on whether this downside pivot is going to be what contains this sell-off, but we'll continue to take it one day at a time, and especially in a low volume tape like this, that's what you have to do.
Right. Well, so meanwhile, there's a group of tech stocks that continue to lead the market higher. A lot of names that we've been talking about recently, especially Facebook. It's been acting well and then broke out to new highs on Friday, gains of more than 5%.
Yeah, I mean, you have a group of tech stocks, like you said, that are just really absolutely dominating the headlines in this market right now and dominating the performance. And it is making things seem a little bit better overall than I think they actually are. But if you're going to be sitting in front of your desk this week, these are the names you have to be watching in both directions. You can look to fade some of these moves, and you can look after some rest maybe on some of these more extended stocks for secondary moves. But you talk about Facebook, great move, extension on Friday. We talked about buying the dip into the $36 level after Facebook really changed character on this earnings gap and go. Prior to that, no real commitment to the upside. Any significant rallies were sold, and it was one that really frustrated traders and wasn't really on the tip of the tongue or the top of the watch list of a lot of traders. But then when you had this earnings gap and go to the upside, it really flipped that on its head. It did a complete 180 in terms of its character, and it's one that I now really trust on dips. And that's why we talked about it so heavily on the $36 level. We talked about it in our Off the Charts newsletter all last week. We talked about it on the price point sheet, 2 of our products here at T3 Live, and in the virtual trading floor. You had several of our contributors watching it and keeping a close eye on it, and then you had that great extension on Friday when a lot of people maybe expected the market to be quiet.
And how much do you trust Tesla now? I mean, Tesla just keeps moving, built on Thursday's gains on Friday with gains of 3%, and it just keeps going.
Yeah, I mean, it's hard not to trust Tesla. I think you trust people and you trust stocks until they prove you otherwise, and Tesla's really done nothing to prove you otherwise. It's really had not much in the way of significant pullbacks, and then they're comparing Elon Musk now very prominently with Steve Jobs because of not only his ability to innovate and his charisma, but also his ability to beat Wall Street estimates. And the company has really gained a ton of momentum. They got a 99 out of 100 on their consumer reports for their Model S car. They got the highest crash safety rating in the history of the U.S. government. Last week it was reported. Take a look at the chart, and you have nothing to discourage you from buying dips at key levels here in Tesla. And you got a new high again on Friday, a nice 2-day potent move. Maybe it needs a little bit of rest after that 2-day move, but this is one that after some rest, it still has about a 25% short float. I would still feel comfortable buying dips, into the 8 or 21-day moving average. So this is one that if you're a short-term trader, this should be at the top of your watch list all the time, as it provides great volatility, great beta in both directions.
Right, and even Apple didn't have one of the best days on Friday, but has been acting well, especially since the Icon news.
Yeah, Apple's such a big component in the NASDAQ that anytime it moves well, it's a really big boost to that index and just overall to market sentiment. And like you said, we've seen that great move from Apple after its fall from grace for most of this year, and that's been a huge boost to the market, and it's been able to cover up a little bit of weakness that's been under the surface, like we're going to talk about in just a little bit. But last week you saw a nice descending channel consolidation form in Apple to allow the 8-day moving average to play catch up. This is a really attractive setup. It's the type of setup you look for now, I think, in Facebook and Tesla, but Apple might be a little bit more calculated setup right now than those other two. As you can see, these lines already drawn in Apple for a potential another leg higher. You could measure the potential measured move after this bull flag type pattern from down here around the 460 area up to 500. You could see Apple up in the 540 area, I think, before you know it, and that would obviously be a big boost for the market. But as we've seen for a lot of this year, Apple can trade differently from the market. It was weak most of the year while the market was strong. Now it's been strong while the market's weak, so maybe the little inverse relationship formed between Apple and the market now.
Right, we've noticed that for quite some time now. Yep. But how about Microsoft? Of course, we know after the news that CEO Steve Ballmer will step down, surge more than 7% on Friday. Do you think there'll be some kind of trade there this week?
I really do, and I'm more in the camp that I think Microsoft can continue to the upside. It is down a little bit this morning, but I think when you get a disruptive gap like we saw on Friday in Microsoft, it's like the gap we saw in Facebook, not quite as big. The Facebook gap was after earnings, but I call those disruptive gaps that I think generally lead to more upside. And we take a look at the chart of Microsoft. This is one that, yes, it was a headline that pushed it higher, and the headline isn't, that they had higher earnings, just that their much maligned CEO is going to step down, which there's, not significantly more value in the company directly because of that, but a lot of people think that Microsoft could separate itself into multiple business units and unlock a lot of value there. So there's just some things immediately that a new leader could do to enhance the value of the stock, I think. And I think institutions are going to notice that. And I think a lot of analysts have been calling for this move to get rid of Steve Ballmer, even though it appears to be voluntary that he's stepping down. But I do think it could get more upside. Look for a price consolidation before just jumping in. I don't think you jump in blindly, but I'm in the camp that this could break above this pivot here from mid-July and make new highs on the year.
And we saw also Netflix make a new high with 3% of gains. Now, this one closed on high, so will this be on your radar for a continuation today?
Yeah, Netflix just continues to prove the doubters wrong. It's one that still has a high short float. It was highlighted as Mark Sperling's first trade idea of the week a couple months ago. And, I wouldn't want to list the same stock twice, but it's one that is setting up for more upside. And they continue to, after a big fall from grace down into the $60 area, I won't zoom out on that chart, but it was all the way down there, and it's more than 400% higher after that, and they continue to make really shrewd moves regarding content. And this chart looks a little bit like Apple, and then it broke out on Friday as you had a nice igniting bar here, a 2-day consolidation, a little descending channel, and then a break above that little pivot there. So really constructive action in Netflix, maybe a little bit overbought right now, but like I said, it has a big short interest. I think it could continue to the upside. If you are going to be sitting in front of your desk this week, this is one that you should be paying attention to.
But then meanwhile, you say that there's a lot of weakness under the surface, that tech is lifting the market, but that there's a lot of groups that are really actually very weak, like the utilities, which have been lagging the market, and that is actually struggling to hold the 200-day, and if it doesn't hold, that looks like it's just going to be in no man's land.
Yeah, like you said, there are a lot of mixed signals and weakness under the surface of the market that really has me concerned. The Fed does hold the key to the market right now with that September QE Fed rate decision. As much as we hate to watch the headlines and things like that, I think you have to with that announcement because the market is very beholden to that right now. But I tend to still feel that there's more risk reward to betting on downside right now, especially due to weakness in some of these sectors. You talk about the XLF is one that I'm really concerned about. It's still below its 50-day moving average. It's a sector that was leading the market for a lot of the year. Got a decent bounce on Thursday and Friday with the rest of the market, but you've seen some weakness and not really strong snapbacks in a lot of these financial stocks that are the bedrock of the market and oftentimes are seen as a bellwether for economic performance and stuff like that. So I think the weakness in the XLF and in a lot of the bank stocks is a big red flag.
Right, and utilities, like I said, which is probably been the worst performer.
Utilities and consumer staples, I lop in the same category. They're both very cyclical stocks. Utilities are more sensitive to rising interest rate environments, which is what we're seeing right now. And I think that's a theme that you should continue to watch going forward, especially if the Fed does move forward with a September QE taper and then a schedule for QE tapering going forward. I think you could really see some underperformance from these high dividend yield safety plays that are less attractive in a higher bond yield interest rate environment. Take a look at that XLU. As you can see, a lot of weakness below its 200-day moving average, with the short-term moving averages curling down really sharply. You saw a nice 2-day snapback on Thursday and Friday, but this is just coming back into its 200-day, so it'll be interesting to see this week whether that 200-day provides or proves to be resistance for the XLU. You take a look at the XLP, Consumer Staples ETF, another one that's sort of in no man's land here, well below its 50 and 100-day. The 8 and 21-day curling down, still has some room to its 200-day, but another one that I would watch for more weakness, especially if we get more indications that the Fed will taper in September.
And we've also, of course, seen a lot of weakness in the home builders as well.
Yeah, the home builders is another one that for a long period of time in the easy money environment was acting really well. Along with the financials, this is one that, and even along with the utilities and consumer staples, these defensive type sectors were performing really well in this low interest rate environment. But you take a look at the chart of the XHB, it's been sort of all over the map. But you talk about all the moving averages sort of close by now, curling down a little bit, the short-term moving averages. It was actually really weak on Friday while the rest of the market sort of just digested. So the 200-day moving average is the key level to watch there. It's flirted with it a couple times, bounced off it back in late June, so that's definitely going to be the level to watch.
Well, like we said before, there's a lot of mixed signals we're getting out there about whether the Fed will actually taper in September. And traders seem to not be totally convinced that they will. I mean, we saw a sell-off in the TBTs, which maybe has traders thinking it won't happen. Yeah,
I mean, you've seen a lot of strength in the TBT. It's a theme that Scott has been talking about a lot. It's the inverse bond ETF, 2 times levered. You've seen a ton of strength there that gives you the indication that the Fed QE taper is priced in. But then on Thursday and Friday, you got a little bit of a pullback. We can go take a look at the chart while we talk about it. Maybe this sell-off in the TBT, and there was a bounce in the TLT, which is the non-inverse. It maybe shows there's some skepticism about whether the Fed is going to taper in September. And I personally, I'm not necessarily convinced that they are going to taper. I think while we have seen some economic improvement, there are a lot of numbers that have still come out that are worrisome. You had the IMF at the Jackson Hole Summit talk about how she thinks that with the recovery still very fragile, she thinks easy money should stay. And like I said, I'm not convinced. The market doesn't seem terribly convinced based on Thursday and Friday, but the larger body of work since that tapering talk started back around May, you've seen that really nice trend in the TBT, which tells you that the market is convinced that the Fed will taper in September. But, it's tough right now because the Fed does hold the key, like I said, but you don't want to be placing bets based on a guess on whether they will introduce new policy measures or things like that. So, difficult environment.
Right. And speaking of those mixed signals, then we're seeing traders actually turn to gold. We saw gold get a push on Friday.
Yeah, I mean, the trends in gold and TBT have sort of been at odds with each other because if the Fed is going to taper QE in September, then that would tell you that gold should go lower because things like QE and easy monetary policy are the biggest price driver for gold. But you've seen gold continue to rally. Maybe there's other factors that are playing into this, and there definitely could be. But in general, I think this move in gold sort of raises a red flag about is September QE tapering really priced into the market. You take a look at the chart of GLD. You had a nice extension on Friday, and that was in keeping with the sell-off you saw in bonds. If you're talking about from a QE perspective, really nice explosive move. Gold, I think, is higher again over the weekend. Actually, here we're down at 134.57. So we're actually a little bit lower now. It actually made new highs over the weekend, but now has pulled back. So maybe a little bit of skepticism in both directions on that. But gold, bonds, something to watch if you're looking for clues about September QE tapering, the potential for that. But a ton of mixed signals that don't really give you a good pulse on what the Fed could be thinking. And nobody really knows, I think. Sometimes word can leak out about different things, but this is something that I think there's a really divisive opinion on the FOMC, the Fed governors in the United States. So I think it's really a wild card. And I don't know if they've made their decision yet, but it would be very interesting to see that decision. But you could see a lot of choppy type action in gold, in bonds, in the market until that decision is made.
Right. So as we head into the first trading session of the week, it seems as though it remains definitely a stock picker's market. So if you can't sit on your hands, it's important probably to keep that in mind.
Yeah, very much so. It's a market of stocks rather than a stock market is what they say. You've seen actually some of the biggest divergence and the lowest correlation in the market you've seen for several years. I think since 2007, you're talking about how much stocks correlate to moves in the broader market. So that does give you evidence that it is a stock picker's market. That's not just a narrative based on some anecdotal evidence. The data actually supports that. So I think you continue to focus on those high beta names. If you're looking for volatility, the Teslas, the Facebooks, the Apples of the world. And I think those are the ones in two-way action, I think, is what you should be looking for right now, not just necessarily looking to buy extensions and stuff like that. And we have some great people on the T3 Live virtual trading floor that can help you navigate stocks on a short-term basis in both directions.
All right, and that's your morning call for this Monday. Happy trading. Have a great day.